Hi, my name's JD Park,
I'm TJ Shelley.
and this is One Stop Real Estate.
So today we're going to be talking about kind of alternative real estate investments. So we got REITs, joint ventures,
Mutual
mutual funds.
tax liens, tax deeds, tons of stuff. So, the reason we wanted to go after this episode is right now in the real estate market, personally, I'm seeing a lot of owner-occupants buying homes, but not a lot of investors. And if an investor is buying a home, I'm seeing it through creative financing, whether that's seller financing, foreclosures, whatever it is. And I have a lot of friends that have talked to me now that the election is over. They're wanting to get into real estate, but they're wanting to do investments. And I always recommend house hacking. But people that already own a home, they're not looking to move. They're looking for answers from me. And I figured that this episode would be a great opportunity for both of us to kind of explain what some of those options are, the benefits, the risks, and just kind of going from there. So we kind of started off with REITs and doing our research on REITs. TJ, can you kind of explain what a REIT is, and what your experience has been with those, if any?
Yeah. So I don't have any personal experience investing into REITs, but I love the idea of it. So a REIT is a real estate investment trust. And essentially what this does, like if I want to go and buy another property right now, just with how expensive homes are, what interest rates are, what rent is, like I'm probably going to have to put down at least 30% to purchase an investment property that I control, manage, and everything.
Yeah.
The nice thing about a REIT is basically it's almost like buying an index fund. You're going to give money into this investment trust, and it can be any dollar amount that you can come up with. It doesn't have to be 30% on a home, but essentially it'll group all of the kind of like an index fund that people buy, almost like a share. It's like a stock. You're buying a share in this real estate investment trust. And if I buy one share, maybe that's like 1% ownership in a property.
Right.
So you're pooling together with a bunch of other investors to finance or to essentially buy properties, and the trust, or I guess it is the trust, is managing the property, the maintenance, buying and selling. All of it's there. It's kind of taken care of for you. You're just buying a share in that company, essentially.
Yeah, so a company puts together a portfolio that they're like, hey, we manage this portfolio. If you want a share or a stake in it, give us money. We'll use your money to buy property, pay management, whatever it is. Usually the trust will actually have their own management team that they pay on salary to manage their property, which is kind of unique. A lot of different investments like joint ventures and things like that, it's similar, but you now have these extra expenses that you have to worry about because you're managing it. With a REIT, it is there's 3 different types, and we'll get into that in a second, but it's professionally managed. So this is their full-time job. They are making sure that their real estate portfolio is doing well for their investors, which is one of the benefits. I really like it. It's a way to get into the real estate market without having the stresses and worries of owning real estate. Or managing tenants or anything like that, which is sweet. The 3 types, well, there's lots of different types of real estate investment trusts, but there's kind of 3 categories that they fall into. There's public, private, and specialty. The public ones are the ones that are traded on the stock market. So if you go on to whatever platform you use, E-Trade, Webull, Robinhood, they'll have real estate investment trusts that you can buy on there and trade publicly. There is a downside to a public REIT, though, is stock traders and real estate investors,
Yeah.
they oftentimes don't know what goes on in each other's world. So a stock trader may see a real estate investment trust, and they're reading flags and everything, whatever the stock is doing, and then they'll buy and dump and day trade,
Yeah.
which will have an effect on how the stock performs. Um, Depending on how popular the real estate investment trust is, will be more volatile to that, versus smaller ones won't. The private real estate investment trusts, they won't, because they're not publicly traded.
Yeah.
They won't have the stock market affecting how well their
Yeah. And
investments doing.
if it's private versus public too, like if you're trading a publicly traded REIT, you're going to be taxed differently. It's going to be treated essentially like a stock. Like
Yeah.
you'll have dividend pay rather than maybe distribution pay.
Mm-hmm.
And then on top of that too, you'll have, you know, long-term or short-term capital gains, which you can have in real estate too, but they'll be treated slightly different how it is public versus private.
Yeah, absolutely. And we'll get into specialty in a second, because I have a lot of things to say about that. But like you said, like we discussed, there's public and private, but then also there's even a further subcategory into what type of real estate investment trust there is. There is a real estate backed investment trust, which is an equity REIT, or there's a mortgage REIT, where it's mortgage security backed. So if you have a preference of what you want to back and you're more secure with in your investments, or whatever, if you're a gambler, you can say, oh, I think this one will
have a good feeling.
Yeah, mortgages, they're gonna blow up, you know. So there's that, and then there's also a hybrid. So they have the mixture of the two. One of the cool things that I was reading about real estate investment trusts is that, let me find it. They are required to pay 90% of their taxable income as dividends out to their shareholders, which I think is awesome, because you can have some security, some belief that whoever's managing it is going to, I mean, the majority of the money is going back.
Yeah.
Right. So I like that there's that restriction. It gives you some security, some ease with what it is that you're investing in, and that because these guys are doing it full time.
Yeah.
Right. So they obviously have to
their
take
life.
a salary,
Yeah.
but at least this way you're not getting taken advantage of.
Yeah.
But I would still do my research into which trust you're going to invest in, who they are, what their portfolio looks like, what type of properties that they manage, their track record, and honestly, who they are as people, you know, if they're going to be good managers or not, because you don't want to invest in with somebody that their specialty is like slum properties, like D-class properties. I mean, unless that's your thing.
Yeah.
But personally,
I mean, it can be profitable, but
yeah, absolutely. Another thing that I did like is the liquidity of it. I mean, you've tied money up in real estate. I know you have a project in Utah County that you've invested in, and you had expressed to me that you didn't really have as much control over that.
Yeah.
What is that like compared to like having that money to be able to be liquid?
Like if you invest money with, I guess this could even go into joint ventures, but if you're working, you know, privately with a group of people to develop a piece of land, like for me, I'm not a developer. I'll invest, right? But it's not my specialty to develop. Right. And there's so many factors, like when it's not something that you can easily trade, like my money is going to be there until the lots sell.
And you have to trust the people that are managing it a lot more.
Yep. So, I mean, luckily I trust all of those people, but I mean, if there's bad weather, like say more from just selling the paper lots, say you go through and you help contribute to the construction financing. Like
Mm-hmm.
if it's a really long bad winter and you can't pour foundations or do things like that,
Yeah.
like your money's going to be tied up longer. If rates decide to go to 9% next year,
Yeah.
it's like your money's there until it's gone, and or not until it's gone, until everything sells.
Yeah.
So like it's great. I think the upside can be really high,
Yeah.
honestly higher than a REIT, but you're stuck with it. Like once you're invested, like there's no other money coming in. Like that money has to make it to the
Yeah.
end.
It's almost like a long-term CD, right?
Yeah.
Like, because how long do those projects usually take?
Yeah, and it depends how they structure it. Like if you're
Yeah.
just selling paper lots, I mean, maybe you can be 6 months to a year depending on
Yeah.
how far along it is. But some of them, it's like maybe if you're taking it from buying the land all the way to completion, like you
Yeah.
might be 5+ years before
Yeah.
everything's developed and sold. So
Mm-hmm. Yeah, and especially with how big some of these communities are now.
yeah, it's crazy.
Yeah. No, absolutely. Um, Being able to get into those bigger projects
Yeah,
as well as, I mean, real estate investment trusts allow you to get into it without having a ton of money. I mean,
yeah,
I know a lot of those um, funds that or crowd-funded
yeah,
developments, they require like a minimum
yeah.
cash amount to
And that too, like it's
invest in.
real estate investing in a lot of aspects has such a high barrier to entry, which is what we were saying before. Like if I want to invest in an investment property, like the barrier to entry is high. If I want to get into property development, then honestly, the barrier to entry is even higher because you have to
Yeah.
know the people who are in it. You have to have funds, and
Yeah.
it's hard. So like things like a REIT makes it so much more accessible to
Yeah.
your everyday person,
Yeah.
which I love.
And the diversification of it.
Yeah,
The last section is specialty,
yeah,
right? There are so many types of different real estate that have REITs for it.
yeah,
Just to name a few, there's healthcare, industrial, data centers, retail, residential, hospitality, self-storage, infrastructure. There's even timberland, which
Yeah.
is just forests. Like
it's crazy.
you can invest in a very diverse amount of real estate and say, hey, I think these areas are going to do well.
Yeah.
Let's invest in them, right?
And as a common person too, like when would you ever have the ability to have somebody come up to you and like ask for money to build a data center or a hospital? Like
yeah.
it helps you be invested. Like people are making so much money off of these
Yeah.
privately. It gives you the opportunity as a quote unquote regular person
Yeah.
to have the opportunity to invest in, things that can be great investment opportunities that you wouldn't have otherwise.
Yeah. No, absolutely. I did want to kind of give some of our opinions of maybe a REIT or a subsection, a specialty of what we think would be good. Personally, I think that data centers are a great idea,
Yeah.
just because that's where all the data is stored. I don't think we're ever gonna shift away from that. I mean,
Yeah.
unless we somehow get sent back to an ice age or a nomadic age, like that's it's not gonna happen. And so I think that's one of the subsections, the specialties that would be a good idea to invest in, just forward looking. Just off the top of your head,
Yeah.
what would be one
My-
that you might be interested
My
in?
mind goes to the same place. Like here in Utah County, like there's a massive data center that's going to, like the Meta data center is going to be built in Eagle Mountain.
Oh, sweet.
And think about how, like, if you go and you look at, like, I recently did a loan for somebody who's working on the project they're building the data center. He's an electrician just helping with that. But when I went to his company and I saw all of the things that they were doing, like they've built so many data centers that I'm like, it's a thing that we need.
Yeah.
And as long as people are using the internet or having online or electronic data, like it's not all just stored on a cloud. Like the clouds
Yeah.
need servers, they
Yeah.
need people to maintain them.
And it's funny because you were just mentioning that you're looking forward to the day where we stop doing closings, like as many closings
Yeah.
in person, and start going remote.
Yeah.
So, I mean, it looks like we're going that way.
Yeah.
Overall, I think if you're looking to put your money into an investment in backed by real estate, I think REITs are a great option, especially if you want to keep it liquid. And I mean, there's still lots of benefits to having real property, like the tax advantages, depreciation, a lot of things like that. But I mean, for a beginner that just wants some of the benefits, I think it's a great start. I do want to talk about some of the other items, that some of the other ways that you can get into real estate without necessarily having to have the money. One of them we kind of touched on is crowdfunding. You want to explain a little bit what that is?
Yeah. So crowdfunding, in some ways it can bleed over into a mutual fund.
Yeah,
It's
no, absolutely.
synonymous, I guess, depending on
It's
how
kind of
you
a
want to
vague
look
term.
at it.
Yeah.
But crowdfunding is, I want to buy a property. I have $10,000. The property's $200,000. And I know 19 people that have $10,000 that also
Yeah.
would love to own a property. So maybe you just establish an LLC. You guys all buy into it.
Yeah.
You purchase the property. It's in the name of the LLC. And if title's held in it, then you own 10% of the property, 10% of the LLC.
Mm-hmm. Yeah. And you can actually do that for not just regular properties, but you can do it for developments. You can do it for big projects. I know a lot of bigger companies, they'll do it. Even real estate investment trusts, they'll buy into them. Just as long as they are seeing returns and everything. So that's one of the ways. I think it's great. There are actually platforms out there that if you're looking to get into a crowdfunding sort of system platform, there's Fundrise, Realty Mogul, and CrowdStreet. Those are all crowdfunding websites that you can go to. One of the risks of crowdfunding is they're less liquid, like we had discussed.
Yeah.
And they are a little bit higher risk, just because you may not see the returns, just the risk of not having access to your money. So obviously that's going to be higher. And then there's mutual funds that are backed by real estate. So those are kind of cool, just because they're not necessarily a full out real estate investment trust. They're just a fund that will invest in real estate. You can publicly trade them, which is cool. And they really diversify, which is nice. Have you ever invested in a mutual fund?
Not like I haven't ever sought out a mutual fund, but
Gotcha.
like investment, like financial advisors have obviously invested in mutual funds on my behalf. So and I'm sure that's like the same as like, even if you have your 401k or whoever, like, I guarantee whatever, if you have a financial planner or somebody or an investment person, like they are most likely putting your money in some type of a mutual fund.
I mean, everybody's heard of Vanguard, right?
Yeah.
So they do mutual funds, but they actually have a real estate backed mutual fund. The ticker for that is actually VNQ. It's Vanguard Real Estate. And then there's another one called Schwab US REIT ETF. So they just threw everything in on that one. They're like, it's a REIT, but then it's also an ETF. Anyways, the ticker for that one is SCHH. If you want to check those out just to see
what they're doing,
what their history has been. I do know real estate investment trusts and real estate mutual funds in general have not been performing super well since 2022. That was kind of the tip of the market when everything was going great.
And that's just real estate.
In
market,
general. So if you are looking for the trends of the real estate market as well, you can also look at those and see what a portfolio is doing. If you don't have access to one yourself, that's a great way to track the trends of real estate. So there are also syndications that are like group investments and longer projects.
I guess when I was talking about crowdfunding, that kind of bled into a
Yeah.
syndication too.
Yeah. I feel like crowdfunding
It's pretty
so
broad.
general,
Yeah.
right? Like it's a system that you use to perform
Yeah.
one of these, right? So that was my bad.
No, you're good. I was
kinda,
just thinking like, wow, Vanguard is just a massive crowdfund.
yeah, no, they
We're
are.
all in it.
So there's syndications, there's partnerships. I like partnerships more than like bigger syndications, just because I really like the tax advantages from owning real estate, and then also the ability to manage them. Just because I had the experience, I was in property management for a long time, have connections in that industry, know how to do it really well, and then also I can use my commissions on as an
Yeah.
investment towards property,
It's
which
nice.
is really cool. So having a partner is a little bit easier. Picking the right partner is important. Somebody that knows what they're doing or fills a gap that you don't have.
Yeah.
The same thing goes for picking a partner in any sort of business. You want to make sure that you guys aren't both providing the
same
same
thing.
exact thing to the same level. And sometimes capital is the thing that they provide.
Yep.
If you have the know-how, you can leverage that. And then there is something called fractional ownership that has become more
That is popular here lately.
Yeah, especially in St. George.
Yeah.
You
All
know,
the desert color stuff.
yeah. So what that is they pretty much fraction off a company, an LLC or entity buys a property and then they sell off portions of that property. And so you can see a 17-person house, 17-bedroom house, and then on the MLS it will show, oh, it's only
$250,000? No way.
And it messes up with my MLS searches so much.
Yeah.
And I'm like, okay, I thought this was going to be a great deal, and why hasn't anybody bought it? And then you read the description.
It's like
Fractional
Yeah.
ownership. So pretty much it gives you an opportunity to buy a portion of a property, have ownership in it, get the benefits. You can actually sell it whenever you want. And sometimes it's even kind of like a timeshare.
That's what I was going to say. I feel like most of those, especially in the St. George resort areas, it ultimately is, to me,
Yeah.
just because the way that they don't do it just by ownership on a lot of them. It's like your ownership equates to weeks,
Yeah.
and at least half of
And
the ones
some of
I
the
see.
weeks don't even make sense. I saw this one in St. George, and it was 1/6 ownership, but you only get 6 weeks.
Yeah,
Like, there's
but they're
52
peak
weeks in a
weeks.
year.
I don't know. It's
Yeah.
it's interesting for sure.
So that could be a good way if you're not wanting to take on all the responsibility.
Yeah.
I'm sure there's somebody. Obviously, just make sure that it makes sense for you. There are apps.
Yeah,
out
sorry,
there.
no shit if you do buy
Yeah,
fractional ownership.
Yeah, there are
I
people.
just don't understand probably fully how it works
Yeah.
or the benefits of it. But
There are people that are huge advocates for it. They're probably the ones that have the listings on all the fractional
they
ownership.
own the fractional ownership and then
Yeah.
sell
So
the fractions.
if you want to learn more about fractional ownership, find one of those listings and contact the agents. They're more than happy to explain it. We obviously haven't done any of that, so not experts, but we know the basics of what it is. Some of the apps that you can download if you want to get into fractional ownership, there's Picasa, or sorry, I misread. Picasso, Pacaso, or Lofty AI. You can download those and see some options for fractional ownership. The last kind of category of investing, if you don't if you can't buy a full property outright, or just don't want to, is tax liens and tax deeds. They're kind of like foreclosures in a way. The tax deed one more than the tax lien, but those are the basic. We want to get into the stuff that people may not have thought about, and tax liens and tax deeds definitely are one of those. So how you get into that is, well, let me back up. The scenario of paying a tax lien kind of goes like this, and we'll get into the tax deeds in a second, but the current property owners, they do not pay their property taxes for a certain amount of time. In Utah, it's 4 years. In other states, it may be longer or shorter, but they don't pay those taxes, those property taxes. And the county actually gives you the opportunity to buy that lien against them, and the property owners now owe you that, including the interest of the property, and some of the interest of the property can be up 16 to 20%, which is nuts. Like a 16 to 20% return on your investment. Like that's what kind of got me giddy in my mind. And so you can buy that tax lien and they can pay it back, and so you get your money back plus the interest. Or if they don't pay it back, you have the option of getting the property.
Yeah.
Now there are some implications on this. One of them is being that any other liens like mortgages and HOA dues may still be on the property when you obtain it. So that kind of is like, okay, you're expecting
and you
cost.
can do a title search on the property.
Yeah.
So obviously that's something you'd want to do before you do a tax lien. If they're upside down on their mortgage and have never paid their HOA dues, then no. You don't want to do that. But.
No, absolutely. And due diligence is going to be a huge part in this, because one of the other risks is the property is kind of dumpy, right? Yep. Like it wasn't taken care of. They smoked meth in it. Whatever they have done in that property, you get that property as is. So there are some of those risks. A good portion of them can be taken out with, like you said, doing due diligence, making sure that doing a title search, making sure that there's things that you are willing to accept when you receive the property. Something I thought was interesting with this, and I didn't read as far into it as I would like to, but some states state that there is no certainty that you will get the property if they don't pay you back, for a number of reasons. I wish I read more into it.
Yeah.
The reason I didn't read more into it is because in the state of Utah, they are not a tax lien state. They are a tax deed state. Pretty much meaning that you can't buy their lien. You have to buy the deed. And now we'll get into a tax deed. And it's pretty much the same process. After 4 years of them not paying, they will auction off the property and you can buy the deed to the property. They do this auction once a year. It said typically May or June. I don't know when the last one was, but typically once a year, and it's per county. So if you want one in a specific county, go find out when that auction is. And typically the bidding starts, because I was trying to run, I was like, how much is this going to cost for a property if I got it at the bare minimum?
Yeah.
And the starting bid for these properties is usually the combination of the back taxes, interest, and then any sort of administration fees or other added fees that the county has added to it. I have the other fee somewhere. But it's all those fees. Yeah. Like that's the starting bid. And then from that point, anybody else that wants to make a bid, you kind of compete, and it can get up there. There's recommendations for bidding in general to set a number. Don't go past that number. Know your parameters. But yeah, so it may get a little more expensive in Utah for a tax deed, but it's still going to be cheaper than buying a property outright. The time frame from when you buy or close on the bidding and to paying the county is pretty quick. So you want to make sure that you can either fund those costs or have a relationship with a hard money lender to get it paid, and then from there you can figure out. You could refinance after you pay it, right? Like once you get title
assuming
and everything,
it's
of value.
Yeah.
So just do some due diligence on those ones. I would really like, I mean, I might even start looking at the tax liens in other states to try it out, because the entry point on tax liens is usually between $500 to $3,000, depending on what property taxes are like in that area. Because if you're in a nicer area, obviously property taxes are going to be more versus lesser. But there are some risks, but
yeah, I will say, like, in just when you summarize it really quick, it seems like, oh, great, yeah, they don't pay their taxes, I get their house.
Yeah.
The foreclosure process is never easy, and it's very lengthy. So, like, if you want to foreclose, just if it goes to court or anything like that, like, you could be
there for a
waiting
long time.
for a very long time to get the property in your name. But
yeah, but it might be worth it depending on the property. It might be worth it. I just know that this was one of the ones that I kind of perked up when I was reading about it. I was like, oh, this is a cool idea. I could see people creating whole businesses based on this and just saying, you know what?
Let's buy some debt.
Let's buy some debt. And so it's a pretty cool way. That kind of wraps up all the things that I had, unless you had anything else.
No, I think that's everything.
So sweet. Yeah. I hope this gives you a good, some ideas to kind of wrap your head around, especially if you're looking to play some money. I know end of the year's right here, and people are trying to scramble to play some money, especially when the market's where it's at right now, and hopefully has hopes to go up and everything. So thank you guys for listening to the One Stop Real Estate Podcast.
Thank you.
The One Stop Real Estate Podcast is a production of Vision Real Estate.
I'm TJ Shelley with First Colony Mortgage, NMLS 1674331, with First Colony Mortgage, company license 3112.